Hi everyone, hope you're all doing well. Today I'm going to talk about the free stocks that I bought not last week, the week before. I'm sorry once again, I'm a bit slow updating you guys on this. It's just that Netflix decided to fall off a cliff, and then Thursday and Friday the whole stock market fell off a cliff. So I prioritised making them videos for you guys, so I'm a couple of days late. So yeah, I'll go through these free stocks that I did buy not last week, the week before, and just keep all that transparency so you guys know what I'm buying in the stock market and selling it in the stock market. I don't want to be a channel that kind of talks about these stocks and hypes them up and then out of nowhere just kind of like, sell them on the sly. I'm always trying to make sure you know what I'm buying and selling at some point during the week. So yeah, we'll get started. Now, if you do want to know when I'm buying and selling companies in real time, the place to be is on Patreon. I post in real time what I'm buying, what I'm selling on the Patreon. As well as that, I put at least 2 exclusive videos a week on there. And also there's a Discord with 600 members to talk to as well. But we'll get started on these free stocks. So I will spend 3 or 4 minutes on them. I won't do a full deep dive on them, but I do have a deep dive, I think, on all 3 of these stocks, a full video on them on the channel somewhere. But all these stocks that I did buy this week are currently positions that I already do own, so I was just kind of averaging into these positions, and I did go a little bit more growth based this week. So the first stock that I picked up, once again a growth stock in the telehealth service, is Hims and Hers. So this is currently a 974 million market cap company, and it came through a SPAC about a year and a half ago, and since then it's been absolutely killed. However, still in my opinion a fantastic company, had a very good 2021, and at no point do I think the share price reflects the financials this company has put in. The financials, in my opinion, in 2021, this stock was probably one of the best financially performing stocks I own. Absolutely amazing. The founder, Andrew Dunham, has absolutely killed it. He's fantastic. I've listened to quite a few interviews with him. He talks about how well the company's doing, and he actually was saying, like, I think we've actually been penalised as a company because we've actually come onto the stock market too early. However, this opportunity coming for us on the stock market so early gives investors normally the opportunity they don't have to get in these amazing companies so early on, and it says it's kind of worked against us, which I do agree. You look at the company, it's founded in November 2017, and the company, the financials this company is putting in for a company that's only been around 4 or 5 years now is just unbelievable. Now, if we do look at the share price, like I said, you can see here, this is where it came through a SPAC in November 2020. Unfortunately, it did kind of get caught up in the euphoria stage, the kind of SPAC hype, and it shot up a huge amount. And I kept it on my watch list, and then by the time this kind of got around to August time and it started getting around to the $8 mark, I was like, oh, okay, this is starting to get interesting here. The company had a very good back end of 2020, really good start to 2021, and I was thinking, okay, it's actually below pre-SPAC, and it just got lower and lower, and as it just keeps going lower, I'm thinking, right, I'll buy some shares. And a few people look at this and go, oh, well, you bought at 8 and it's down at 4, so that's a bad investment. And some people look at that point of view, and I look at it, point of view is like, okay, maybe I was buying this at $8, but the fact that it's now down at $4 is unbelievable. Like, this is just giving more and more upside in long term, and in the short term it might be a little bit painful to be going through that, but I look at this as a great opportunity to just accumulate more shares of a great company at even cheaper prices. I mean, this might go down to $3 or $2 for all I know. I mean, it'd be crazy if it did, but if it did, so what? You know what? It might be a bit of a crappy kind of 12 months, but in the next 5 years, this is one of the companies that I own that I think will potentially give me a 5x return, potentially up to a 10x return. And if I get one stock that lands a 10xer, that is where I will outperform the stock market, the S&P 500, in the next few years. And Hims and Hers could potentially be that. I would generally think that Hims and Hers has a decent chance of getting to $20, and then we talk about $40 in the next 5 years. Potentially. Now, at the moment, Hims and Hers isn't a company that loses too much money as a growth stock. It's very much focused on revenue growth though, and like I said, it had a very good 2021. You look here, for the full year, this was actually in the Q1 2021, so the start of last year, and you can see here they were expecting revenues to be in the range of 221 million to 227 million. Well, by the end of the year, we actually saw them deliver 271 million, which was absolutely fantastic. And this company has really good gross margins at 75%. Like I said, if this company really wants to be profitable, it could be profitable. But it has been very aggressive with its growth, its acquisitions. So I think this company is not too far off profitability in the next 2 years, and the growth of it has been absolutely fantastic. This company's been growing, at the range of 74% year over year, which is a really good rate. So I think you've got a company with really good margins here, very easy to get to profitability in a very good growing area, the TAM, the telehealth space, which is great. And what Hims and Hers have been doing is they've announced a lot of new partnerships throughout the last 12 months. Now, I have noticed recently, Hims and Hers haven't been announcing that many new partnerships. I actually generally think that Hims and Hers have just got to the point of view where they've gone, you know what, we're actually not going to announce any more new partnerships, because what should send the share price up seems to send our share price lower. And this is the thing, like Hims and Hers been announcing all these partnerships and they've been leading to more and more revenue increasing, and rather than getting rewarded for it, all that's happened is the stock price has gone down, which is crazy. And some of these partnerships have been landing have been really good as well. Now, like I said, Hims and Hers currently have quite a few different income streams. The income streams that are very easy to use over telehealth services or send products out after using a telehealth service. And what Hims and Hers are going to do is expand this range in the next few years. So this is currently the services that they do offer in. So this is what they had when they came through with SPAC, hair loss and ED. Recently they have launched the new products, and you can see here going forward there's potentially the next 4 income streams that they add in, and you can see here the potential market that they are in as well. So yeah, this company is just going to keep adding into these, or tapping into these little markets as it carries on, and offer the opportunity for it really does go for the younger generation through the telehealth service, and there's a big market for them to take there. When we look at the companies, like I said, it doesn't really lose too much money. It has dropped a bit down on, if you look here, like it wasn't really losing that much money, but see here, it has lost a tiny bit more money this year. The reason why is because it's got a few of the SPAC expenses. It's been making a couple of acquisitions, so it does look like the losses are quite a bit this year and have been increasing, but that's the reason why. You can see here that analysts are projecting that losses is going to halve this year, and I think that would happen unless they go for any more crazy acquisitions. And I think, by 2023, the analysts are predicting that the company will probably lose 32 million. I can only see them losing 32 million if they make a lot of acquisitions. I won't be too surprised if you see 2023 this gets very close to profitability. Now, analysts actually do have it in 2024, but yeah, I think that will be something to watch out for that might take people by surprise. And when you look at the revenue growth here has been increased a lot recently. Analysts were really predicting like 30% revenue growth, but they've just been hiking it up. The thing is, this company's, it can put quite a few surprises in. It can grow a lot faster than that as well, which is important not to forget. From a metric point of view, obviously there's not much we can use on the profit side, but from a total price sales ratio, it's down at a 2 now. Total enterprise value to revenues, it's down at a 1 as well right now. And with the gross margins that it has, it's like I said, it's not going to be too hard to get to profitability. And when these guys start racking up some profitability, it's only a 900 million market cap. It's not going to be too badly valued there as well. So yeah, I think this is a very good value for a very good growth stock. So I did pick some more Hims and Hers up. Next one, I'm sure you probably know I was going to buy this one at some point. I've not bought it for a few weeks. DraftKings, same again. Unfortunately, it's in the kind of risk space. No one wants anything that is risk associated, nothing that loses money, and especially anything that's come through a SPAC. And what you'll notice is Hims and Hers came through a SPAC, being killed. DraftKings came through a SPAC, being killed. So it's definitely a common theme out here. It doesn't mean these are terrible businesses. It just means that, in my opinion, you've got two really good growth companies in 2 really big growth areas in the next 5-10 years that are massively on sale. And like I said, DraftKings, same again. January 2020, starts coming through the SPAC. We're now, nearly 2.5 years on from when it came through a SPAC, and the company is basically nearly the same. Well, it's not the same value, it is a little bit higher, but it doesn't really reflect how good this business has been in the last 2.5 years, and it's just unbelievable to see this down at now a 6 billion market cap company. In my opinion, in the next 10 years, I see DraftKings becoming a 100 billion market cap company. It's the first stock that I've seen on the levels of when I saw Square in 2017. I was like, this is going to be so successful in the next few years. And the only other one that I've seen since Square was Shopify. Shopify was the other one that went, this is going to be massive. This is going to reinvent e-commerce. Square's going to reinvent the payment space. Shopify is going to reinvent the e-commerce space. And, I own Tesla, but I didn't think Tesla would go crazy as what it did. The only one that I've seen on them sort of lines is DraftKings. This is a new TAM that's just popped up within the last 4 years. And DraftKings are going to be probably one of the top 2 leaders in this space. And I think with Jason Robbins there, he's also going to expand this just past not being a sports betting company, but a fantasy sports, an NFT platform, potentially a media outlet. It's going to be a massive player in the next few years. And this is what I mean. In 2018, it was only allowed then that in the US, states could go and do sports betting online, and it's a massive new growth area. We know how successful it is in the UK, and in the US, same again, it's going to be a massive boom in the next few years, and I think DraftKings is going to be one of the major players. And at the moment, you can see here that online sports betting, it says that in the States of February, it accounted for 30% more of the GGR, which is the number one, and behind it, Flutter on 28%. There's a lot of different numbers depending what you go from, who is the number one between DraftKings and FanDuel. But between them, DraftKings, FanDuel are probably going to control this area. Potentially BetMGM getting here, but these are going to be the top two players. And all DraftKings needs to do is kind of hold around this 25 to 30% range. If it keeps the market share of that much, it'll have a very good future going forward. I'd say again, the company's absolutely smashed it the last 12 months. At the start of the year, we were expecting DraftKings to do, 750 million to 850 million. And then in Q1, they did hike it up to 900 billion to 1 billion in revenue. And then it went on to do 1.3 billion in revenue. Last quarter, it absolutely smashed it on the guidance side of it. And once again, we've just had a big, massive hike up. The expectations was to be around a range of 1.7 to 1.9 billion. And actually, it's now going to be between 1.85 to 2 billion. I actually think by the end of the year, don't be too surprised if DraftKings actually hits around about 2.3 billion this year. So once again, they're absolutely smashing it once again. And really, the only criticism the DraftKings have is the money they burn through. Well, that's what a lot of the negative bears use against the company. But if you actually look at the company, they only use the cash burn to get new states, acquire customers, and eventually the customers they acquire return to profitability. And now a lot of the mature states are starting to kick in. The mature states are starting to generate or contribute to profit. They've got 5 states that do that. By the end of the year, they're going to have 10. If they wanted to, they could have got to EBITDA profit this year, but it will be next year because of new state launches. The gross margins are even better than what expected. The long-term profitability has just been risen. So only the people that don't really understand the story of DraftKings use the money they're losing against them. But if you actually look at the story for the profitability is just getting better in the long term, because it's a proven model now that it gets to profitability, good amounts of profit, really good margins as well. So yeah, these people forget that this only really space got created 3 years ago, and look at the boom that it's already had in 3 years. This is a really early stage industry. We're nowhere near a mature state at the moment. This is one of the biggest upcoming TAMs. You look at this TAM in the next 5-10 years. This is where I think DraftKings will be. You'd be talking about a 100 billion company in the next 10 years. So again, on the valuation, there's not many profit metrics to use because it does lose a lot of money. However, you do look at that it was trying at 23 times revenue, 23 times sales. It's now down at 2. Yeah, it is crazy. So yeah, I was picking up some more shares of DraftKings, and the last one is Boohoo. So I've talked about it a lot on the channel. You guys know I'm a big Boohoo fan. Currently trading down at 18 times earnings, but it could be a little bit questionable. The profit could be a little bit here, there, and everywhere at the moment, which we'll talk about in a second why that is. The stock though has been plummeting. Once again, you look at this share price here. It's down at 87p. Last time it was down at 87p was around 2016, which is crazy. So yeah, massive wipe off in this stock price. Now you'd think if it's fallen to the lowest it's been for like 6 years, you'd think there's something crazy going wrong with this company. However, there's not, and this is why I think it's a good opportunity to buy this e-commerce brand. Now, it's probably important to say that they are reporting earnings on the 4th of May, and I actually think Hims and Hers are reporting that week, and I believe DraftKings are, which I think is 2 weeks time. So I will say that I'll probably be giving a bit more of an update when they come out with their earnings. But they own a lot of brands now. It's not just Boohoo brand that they own all of these brands: Pretty Little Thing, Nasty Girl, Oasis, Dorothy Perkins, Burton, Debenhams. So this used to be a brand that was a lot more focused around the younger generation. I would say it does every single generation now. I think a lot of the brands it owns a lot of its own brands as well, which gives it the better margins compared to something like an ASOS, for example. And it's also expanding just past the clothing range now into the beauty area as well, which I really do like. It has really come to complete business in the last few years. And the reason why the share price is down is because it's been hit by a lot of the logistic issues. The logistic issues have costed them more money to send things. There's been a lot more returns. Once again, that leads to more logistic issues, and the logistic issues have stopped them getting products out to Europe. So that's affected the Europe sales slightly as well. So yeah, a lot of it is basically around logistic issues, which we've been aware of by a lot of companies in the last few months, and it has hit the profitability, as you can see here, at the moment of Boohoo. Now in the long term, I think this is only a short-term problem. There's no problem with the revenue. It's just that the logistic issues hit them, and I think in the long term these logistic issues will either solve by Boohoo raising their prices, or that shipping does come down after this kind of impact of economies opening up and closing down so much. So I think this will be a problem that is solved in the next kind of 12 months. But then what you're left with is a company that is doing nowhere near the revenue it was doing in 2016. I mean, look at the revenue growth from this company. And like I said, the profit has been hit a little bit, but within the next kind of 2 years, I think we'll be talking about a company that then moves back towards doing potentially 100 million in profit. We start talking about 100 million in profit. This company trades down at about 10 PE. And for a growth company, trading down at 10 times earnings, not too bad at all. Once again, it is founder-led, and it's a very healthy company. There's no debt on the balance, or there is a little bit of debt on the balance sheet, but apart from that, it's only 50 million. It does sit on quite a bit of cash. It sits on 148 million cash, and that's with a lot of acquisitions that it's made recently, like the Debenhams acquisition. So, this company's always generated really good amounts of profit and led it to have a strong balance sheet as well. So, yeah, I think this is just a short-term issue that's affecting Boohoo, and when I look at the short-term issue, to justify it going all the way back, like I said, down to 2016 prices, crazy. So I think this is once again a bit of an overreaction on this one. So I picked up some more Boohoo shares. So those are the 3 stocks that I've been buying anyway, guys. Let me know what you've been buying in the comment section. Hope you enjoyed the video, and I'll catch you in a bit.